On April 7th, at 5:32 in the evening, Donald Trump announced a ceasefire with Iran on Truth Social. The following morning, the S&P closed up 2.5%. The Nasdaq gained nearly 3%. The Dow climbed over 1,300 points, its single best day in almost a year, and financial media called it a relief rally, markets celebrating peace. Move along. Nothing complicated to see here. A few weeks later, stocks were sitting at record highs. There was still active war going on. The Strait of Hormuz was still largely closed. The ceasefire was visibly falling apart in real time. That explanation is wrong, and I can prove it with data. I'm Jimmy, and this is Finance Misfires, where we break down what actually happened underneath the headline, because the mechanics driving that rally have nothing to do with peace, and everything to do with how the modern market structure actually works. The rally didn't come from nowhere. Here's what Wall Street was sitting on going into it. On February 28th, the US and Israel launched joint airstrikes on Iran. Supreme Leader Ali Khamenei was killed. Iran retaliated by shutting down the Strait of Hormuz, the narrow waterway carrying roughly 20% of the world's daily oil supply. What followed was the market's worst 5-week losing streak in nearly 4 years. The S&P dropped close to 9% by end of March. But underneath the index-level decline, something more significant was building. Wall Street wasn't just nervous, it was repositioning at a pace not seen in over a decade. Goldman Sachs runs what's called a prime brokerage desk, a service that handles the trading activity of most major hedge funds on Wall Street. They see what these funds are buying, what they're selling, and exactly how leveraged they are in real time. According to Goldman's own internal data, Q1 hedge fund selling in North America was the largest since April 2020. Gross leverage across the industry was sitting above 300%, near an all-time high, and short exposure to macro ETFs like SPY and QQQ hit the highest level since the pandemic. In plain English, by the time Trump sent that Truth Social post, Wall Street was loaded up on short positions, betting the market would keep falling. Hedge funds were positioned for continued deterioration. The sentiment across the street was about as bearish as it gets. And then the ceasefire dropped. Here's where the mainstream narrative completely falls apart. Maritime intelligence firm Windward, which uses AI to cross-reference digital GPS signals with satellite radar and imagery, tracked tanker activity through the Strait of Hormuz the morning after the ceasefire announcement. By midday on April 8th, only 5 outbound carriers were detected moving through the strait. That's a roughly 96% decrease compared to the pre-war baseline of around 130 daily transits. Read that again. 96% decrease. The strait wasn't open. Peace hadn't arrived. The physical reality on the ground hadn't changed by a single meaningful data point. And yet the S&P was ripping 2.5% higher, and financial media was calling it a peace rally. So if it wasn't peace driving the market, what was it? A good old-fashioned short squeeze. And the data makes it undeniable. Here's exactly how a short squeeze works, because the mechanics matter for what comes next. When you short a stock, you borrow shares and sell them, betting the price falls so you can buy them back cheaper and pocket the spread. But if the price goes up instead, you still have to return those shares, which means buying them back at a loss. And if the price keeps climbing, the losses compound with no ceiling. Margin call. Add capital now or close the position immediately. When enough traders hit margin calls simultaneously, they all buy back shares at the same time. That buying pushes prices higher. Higher prices trigger more margin calls, more forced buying. The loop accelerates. Going into April 8th, the conditions were perfectly set. Macro short exposure at its highest since the pandemic. hedge fund, leverage above 300%. An entire street positioned for continued decline. Then a single Truth Social post shifted sentiment and the squeeze began. But the short squeeze was only the trigger. The second domino was significantly larger. The second was the CTA flip, Commodity Trading Advisors. These are systematic trading firms running purely rules-based algorithmic models. They don't read earnings reports. They don't analyze geopolitics. They don't care whether the war is actually over or whether the strait is actually open. Their models follow price trends mechanically. Trend down, go short. Trend up, go long. No judgment, no discretion. Goldman reported that CTAs were sitting on approximately $30 billion in net short positions going into the ceasefire announcement. But the moment the S&P crossed certain algorithmic trigger levels on the way up, those models didn't shift to neutral. They flipped aggressively long. Goldman's original estimate was that CTAs would need to buy back around $40 billion in equities to unwind their short positions. The actual number that moved through the market across just 5 trading sessions was $86 billion, which Goldman's own records flagged as a top 5 all-time buying speed print. $86 billion. 5 sessions. Not because anyone analyzed the ceasefire terms, because an algorithm crossed a price threshold and followed its rules. The third domino was the options market. Dealers on the other side of options trades are required to stay delta neutral, meaning they constantly hedge their exposure by buying or selling the underlying stock as prices move. Spot Gamma, a leading market structure data platform, had flagged a negative gamma regime heading into the ceasefire. In a negative gamma environment, dealer hedging behavior flips from market stabilizing to market amplifying. Price goes up. Dealers buy more stock to hedge. That buying pushes prices higher. Dealers buy more. The feedback loop compounds in real time with no fundamental anchor pulling it back toward reality. Short squeeze, systematic CTA flip, options dealer gamma amplification, 3 dominoes, all falling in sequence, all within the same 5 trading sessions. That's the rally. That's what actually happened on April 8th. Not peace, not relief. Not rational market participants reassessing the geopolitical situation and concluding the worst was over. Mechanics. Pure, cold, structural mechanics operating entirely independent of what was happening on the ground in the Middle East. Here's the thing that makes this rally genuinely important to understand beyond just April 8th. It's not a one-off anomaly. It's a pattern, and it's been playing out with increasing frequency and intensity for the better part of a decade. Go back to December 2018. Stocks had been selling off for months on Fed rate hike fears. Then Jerome Powell uses one word, patient, to describe future policy. The Dow gained over 1,000 points that day. First time in history. Not because fundamentals changed. Because one word shifted positioning across a structure primed to amplify any directional signal. August 2024. The Bank of Japan raised rates for the first time in 17 years. The yen carry trade unwound. The Nikkei dropped 12% in a single session, then bounced 10% the very next day. Different catalysts, identical mechanics. The reason this keeps happening isn't random, it's structural. 20 years ago, the U.S. stock market was primarily driven by discretionary human judgment, portfolio managers reading earnings reports, fund managers deciding what companies were actually worth relative to their price. That market is essentially gone. Today, 63% of all U.S. stock funds are held by passive index investors, $13 trillion allocated mechanically, buying more of whatever's already biggest, regardless of valuation. It doesn't read earnings reports. It doesn't model cash flows. It follows the index on autopilot, which is exactly how the Magnificent Seven came to represent over 33% of the entire S&P 500, not because 7 companies are worth a third of the American economy, but because passive allocation mechanics keep funneling more capital into whatever's already large. The active investing side that remains has also transformed completely. The hedge fund industry has consolidated into a small handful of massive multi-strategy platforms. The Millenniums, the Citadels, the .72s of the world, running at 4 to 8 times leverage with strict automated drawdown rules. When they hit a drawdown limit, they don't convene a meeting to debate whether the geopolitical situation has genuinely improved. Their systems sell immediately and automatically. And underneath all of it, the options market has become something that would be completely unrecognizable to a trader from 15 years ago. Same-day expiration options now account for roughly 63% of all S&P options trading. On peak days, over $2 trillion in notional value changes hands in a single session. Every single one of those options forces a dealer on the other side to hedge continuously in real time, buying or selling the underlying stock to keep their books balanced as prices move. The dominant players in 2026 aren't analyzing valuations, they're reacting. And when price moves, their reactions stack on top of each other and amplify the move further. Passive funds allocate mechanically. Algorithms flip at price triggers. Options dealers hedge in real time. Margin calls force liquidations. The feedback loop is the market now. The fundamentals are just the narrative people construct afterward to explain what the machines already did. That April 8th rally wasn't irrational. It was perfectly rational, given the actual structure of the market doing the moving. The ceasefire announcement was the spark, but the fuel was $86 billion in forced CTA buying, a short squeeze across the most heavily shorted macro positioning in 4 years, and options dealer gamma amplification all triggering simultaneously. Peace had nothing to do with it. The Strait was still 96% closed. The war was still ongoing. The fundamentals hadn't changed by a single measurable data point. But understanding that, really understanding it, changes how you see every your leaf rally and market panic the financial media hands you going forward. The headlines aren't the story. They're the rationalization people reach for after the machine's already moved. This is exactly the content finance misfires exist to put out. Not the dumbed-down version. Not the narrative that fits neatly into a 60-second segment on financial television. The actual mechanics, the short squeezes, the algorithmic triggers, the gamma regimes, that explain why the market does what it does, while the headlines explain something else entirely. Leave a comment. Which of the 3 dominoes do you think does the most damage when they all fire at once? The short squeeze, the CTA flip, or the gamma loop? Share this with someone who still thinks stock market rallies are rational responses to real-world events. Subscribe to Finance Misfires for more of the stuff traditional financial media conveniently forgets to cover. I'm Jimmy. The machines moved. The media made up a story. Now you know the difference. I'll see you in the next one.